everyone. So my name is Micah Smith, actually, formerly Micah Curtis. Married name is Micah Curtis. And you're going to find I'm obsessed with credit. I love credit. I love talking about it. I love teaching about it. I love helping people understand why it's so important. When you sit down and you crunch the numbers like I do, it almost makes you sick when you know how much people are overpaying for stuff. And that's why it's so important to understand how this whole system works, right? Because if we don't, not only we're not going to get approved, we're going to get approved at rates that are just much too high. And I'm sorry, but the big banks, they make enough money. Please, let's try to keep our money in our pockets where it belongs, right? So, Bruce gave a very, very lovely introduction. So there's really no need for me to continue introducing myself. So I'm just going to go ahead and I'm going to jump right into it. Obviously, so good credit is the foundation, right, to having any sort of just good life, right? So the first question I start off with, and my loan originators, most of you are probably going to know the questions I'm asking. So I'm just going to ask the group that I haven't seen yet. So I always make my presentations really super interactive. I'm sorry I can't talk to the Zoom people, but it is what it is. So this way you can actually absorb more. Okay. So the first question I always ask when I start a presentation is to pay or not to pay, right? That's always the question. This is like the first thing that always pops into people's minds when they're looking at their credit and they're trying to fix their own credit. Like, so listen, if you have a collection, right? Everybody knows what a collection is, hopefully. Does anybody not know what a collection is? Okay. So you don't know what a collection is? Oh, so a collection is, so if you have, let's say a bill, let's say it's a utility bill. Okay. So you were supposed to pay the gas company, let's say $75, somehow slips through the cracks. You never maybe even got it. And somehow, right, as we know, it doesn't report positively. So you don't get credit for making positive payments, but if it goes into collections, it might hit your credit report as something negative. So when a collection hits your credit report, it takes the scores down, right? So let's pretend we have a utility collection for $75 with PSEG, right? Let's pretend, right, let's say it's 4 years old and you're like, you know what? I'm gung-ho about fixing my credit. I'm going to buy a home. So do you pay the collection or do you not pay the collection? That's always my first question. So who says pay the collection? 1, 2, 3 hands. Does everybody else say not to pay the collection?
We've been to your seminar.
Okay, so why would you, and tell me your name, Mike, right?
Collection showing up on the credit report.
Okay. Okay.
Well, now I'm going to go with that thing.
Okay.
But probably wouldn't you want it to say paid collection on the report as opposed to open collection?
Okay, I like it. Very good. I like the wheels are turning, the synapses are firing. Well, you're like shaking your head vehemently. No.
Actually, my understanding is if it shows as paid collection on the credit report, it actually negatively impacts.
But why?
The way you get that removed, if you pay it and have it removed from your credit report, your scores will go up much faster.
Got it. Got it. So what do you think? Yeah? Okay. Is it, and who else said pay it? Is everybody afraid of the pay it? Okay, so the answer is, so 99% of the time, right, we don't want to touch a collection 99% of the time, which is so counterintuitive, right? So I always talk about credit and I let people know it's not common sense. You take logic and you throw it out the window, right? So what happens, so to really dive deep into what actually happens to your credit score when you pay a collection. So if it's not deleted, right? If you don't negotiate a pay to delete, which most companies don't do a pay to delete, that's the problem, right? So if you pay it, what usually happens is this. There's a little acronym on every report, which is DLA, okay? What do you think DLA stands for? Michael? Yeah, yes. Date of last activity. Okay. So, so the newer that is, the more impactful negative item is to the score. So what happens, let's pretend that 4-year-old utility bill, right? You pay it, the date of last activity becomes today, right? So now it's going to be 8/17/2022, right? So, or is it 8/18? 8/18/2022, sorry. So when it's new, the scores drop and then the negative item will now stay another 7 years on the credit report from data satisfaction. So that's the mistake that I see 80% of my clients make, is they get gung-ho about fixing their credit and they want to do it by themselves. And they start paying off all their collections and they call me frantic. Why did my scores just drop 60, 70, 80 points? And I look at it and I'm like, oh, like you paid all your collections off. And that wasn't the right thing to do. They're like, you got to be kidding me. So not only are they out money, their scores are worse than ever, right? So we want to avoid people from making that mistake. Now, if you run into the situation, right, where you can do a pay to delete, I can coach you through that, but you just don't want to put yourself into a worse situation. So generally speaking, the rule is don't touch it. And, or if you want to touch it, make sure I give you the green light, because otherwise you'll put yourself into a bad situation. Okay. So generally speaking, we don't want to touch them. One thing I want to address is a monster change that took effect July 1st of this year. Has anybody heard what's going on with medical collections lately? Has anybody heard all the big changes? Johnny? Yeah. Okay. So glad I'm teaching this, because let's learn what's happening with medical. So medical collections, so the CFPB, the Consumer Financial Protection Bureau, they're really big on protecting us, the community, right? So essentially they put out all these crazy reports and analysis. So what happened with medical? So medical used to be credit restoration's bread and butter. It was so common to see medical collections on credit report. It was 50% of all collections were medical. It was insane. So what happened used to be you pay the collection, right? You have a satisfied medical collection for 7 years, does damage for 7 years. We would go in and try to clean that up. Now, as of July 1st, 2022, any paid medical collections are automatically removed from the credit report. Millions of collections, July 1st, 2022, were removed by the bureaus, only if they were paid. Only if they were paid. Okay, so here's the second thing. So people are like, okay, so medical is no longer impacting my score. Not the case. Medical, if it hits your credit report and it still has a balance, it's still going to impact your credit scores. It's still going to hit the credit report. Next year, January 1st, 2023, the new rules that they're implementing is it's going to be anything less than $500 will no longer hit the credit report. Okay. And remember, satisfied medical collections come off, or if you pay the collection, it's going to be removed, and they're going to give you a longer time frame to actually negotiate with the doctors before it even hits the report. So those are the changes. Yes.
So under 500,
they won't report. They won't report at all. Yes, they will not report. So that's the thing. So January 1st of next year, that takes place. Okay. Yes.
How quickly will it come off?
It like 30 to 45 days. So it's literally the next month, the next time that they report it, it's like this, it's like clockwork, which is great. So that's a huge win for consumers, because medical is a monster problem. And especially now with COVID, right? COVID has caused so many people to just see all these like little mini copays, and they're slipping through the cracks, and they're seeing it's going to become a bigger and bigger problem. So that's why they implemented all these rules. Any other questions about collections, medical, what's going on? Good. Okay. So let's move forward. What is my next slide? So this is one of my favorite things to talk about. So I'm not going to go into all the specifics on Vantage, but I want to talk about one of the biggest issues that I see when it comes to real estate versus the mortgage industry. So your client sees something, and then the loan originator sees something very, very different. And I really want to talk about that, because it's one of the biggest misconceptions and probably one of the biggest frustrations that I see from clients today. So please tell me, everyone's heard of Credit Karma? Yes, right? Has anybody not heard of Credit Karma? No? Okay. So if you have a client, right, let's say they go to Credit Karma and they pull their scores there. Let's say they see a 720, right? And they're like, yes, I'm going to go buy a home. And you're like, great. So then you send them to Bruce. So Bruce then is going to, right, he's going to try to get them pre-qualified, right? So he's going to do a hard pull. And then Bruce sees something very different than your client. Okay. So in those types of situations, why do you think that is? What is your name? Eva, why do you think that is? Like, if you have a client and they're like, Eva, like, you sent me to Bruce and he seems so nice, but I think he just dropped my score 100 points. I have a 720 and he pulled a 620. What's going on? Like, what would you say? Go to a different lender. Say it again. Okay, that's a good thought. What was your name? Jane, what would you guess, Jane? What do you think you would say?
I think they use a different way to calculate the score.
Very nice.
You very similar to your credit score is just like expanded but you go to the mortgage, they use a different formula
Yes.
to get the score.
Yes. Jane, were you in one of my classes? Awesome. All right. Very good. Awesome. Awesome. Very good. All right. So listen, this is not something that we're taught, guys and gals, right? So at the end of the day, one of the most important things to take away when you're talking to your clients about credit, I have a really cool trick to make you sound really educated. Get the word algorithm into your vocabulary. Algorithm, 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 right? So at the end of the day, fun fact is that, so the mortgage industry has a total of 51, FICO has a total of 51 FICO algorithms used to calculate your scores. Okay, so there's 51 FICO algorithms, and then the actual, so Credit Karma, they use what's called a Vantage model. Okay, so a Vantage model is very, very, very different than a mortgage scoring model. Okay, so the Vantage model, on average, it's 40 to 60 points higher than a loan originator's scoring model. Okay, so at the end of the day, you really want to make sure that you understand the difference between the loan originator's model and the Vantage model. Okay, so Credit Karma, right? So Credit Karma, this is Vantage. Okay, so Credit Karma, they use a consumer scoring model, right? So you can't use it to buy anything. So like one of the most common questions is, where do I go to find my correct credit score? Right. So people are like showing me their banks, and they're like, well, my bank says this and my loan originator says this. Right. So at the end of the day, wherever you get your score pulled, that's your score with them. It's not transferable. So it's one of the biggest misconceptions. One of the biggest issues that I saw is I had a client, right? So she pulled a 640 on her Credit Karma, and the loan originator pulled a 440. The reason why, so Credit Karma, right, it only goes back 2 years. It's a very shortened version of what's actually on your credit report. Okay, so you want to make sure, right, you know what is on your credit report. And I have a lot of solutions for you, of course. I'm not just going to like leave you out there and throw you to the abyss, right? At the end of the day, you want to make sure that you understand there's a vast difference between the scoring systems. So get the word algorithm into your vocabulary. Every industry uses a different algorithm to calculate your score. So you have mortgage, you have auto, you have credit card, you have online, you even have insurance as a fifth. They all will pull different scores for you. Does that hopefully make sense to everybody? Okay, so I have a really cool solution for everybody here. So if you're ever just really, really curious what your mortgage score is, you can go to myfico.com. So myfico.com. It's 100% accurate. It's a soft pull, which means it does not hurt your score. You can see your mortgage scores in myfico.com. It is an awesome, awesome, awesome resource. Okay, awesome. So now let's go over. So I want to go over how your scores are broken down in the mortgage industry. Okay, so the mortgage industry, right? So they're going to look basically at these 5 things, and this is how they weigh your score in the mortgage industry. So when you're trying to raise your score, I'm going to help people obviously figure out how these little sections work. So 35% of your credit score is going to be payment history. Okay, so anytime you do anything good or anything bad, it shows up right there. I don't spend any time on that because that's the only part of credit that actually is common sense. What I want to focus on is the other 65% of this pie chart, because if we don't understand the other 65%, we are never going to get the scores that we need, want, or deserve. Okay, so I'm going to spend a decent amount of time on this section right here, which is amounts owed. Okay, so amounts owed is also going to take into account something that we swipe every single day. Any guess what that might be? Credit cards. Right? So this is going to also be what we call revolving. Okay, so revolving. So when a loan originator looks at the credit report, he's going to look at, it's going to say REV. Okay, so revolving. So revolving is 3 types of trade lines. Any guesses what they are besides from a loan originator?
Like what you're swiping on?
Yeah, no. Like what type? So there's credit cards, but there's 2 other types that technically fall under revolving. You said something? Ooh, okay. I'll answer for it. I'll answer. That's a really good guess. Really good guess. Does debit report to credit reports? Yes or no? No? You sure? Okay. Michael? Yes, line of credit. So store cards, credit cards, and lines of credit. Okay. Yes. Yes.
Versus American Express?
Yes.
Are they still the same?
Yes.
They're both store cards.
Yes. Yes, yes, and yes. And this is like one of the biggest misconceptions. People are like, all I have is a stupid TJ Maxx card. And I'm like, but it's doing so much good for you. Okay. So store cards, credit cards, lines of credit. Those are the three most important, most impactful components to your credit score. You have to have them. You have to. You have no choice, right? So oftentimes I'll pull someone's credit and I'm like, ooh, like your score is not so good, but guess what? It's a quick fix. All you have to do is get a credit card. And they're like, what? I hate credit cards. I'm like, too bad. You got to get one. Doesn't matter. You have to have them, right? So you have to just learn how to properly use them, but they are so heavily weighted in our credit scores, right? 30% of the credit score versus, let me show you something really interesting. This is where your mortgage falls right here. Your mortgage is types of credit right here. Your little $200 Home Depot credit card weighs more than your mortgage. It weighs more than your car. It weighs more than your personal loans, more than your student loans. Okay. So it's so, so, so important to have credit cards and use them correctly. We haven't been taught this stuff, right? So that's why we're seeing people's scores fluctuate up and down constantly. So I want to talk about something really important in this section, which is one of my favorite principles. There is no bias towards wealth in the algorithms. What in the heck does that mean? That was that percentages. Yeah. But what it also means, right? So if we have, right, if we have two credit cards, a $10,000 credit card, right? Let's say they were opened at the exact same time. Okay. You have a $10,000 limit and you have a $200 credit card with a $200 limit. Which one's helping you more? The $10,000 credit card or the $200 credit card? Same. Somebody said 200? 200? Okay. Why do you think 200? Okay. Okay. All right. I like it. I like it. You're thinking. This is good though. You're thinking. This is really good. You said the same. What do you think? Yes. And what's your name? Diana. What would you think? Okay. Why? Okay. All right. So we got the synopses firing this morning. I love it. Everyone's awake. All right. So Michael.
I think they're rated the same because the credit bureaus are not biased as well.
Very good. So they're equal. Yeah. So but that's the thing is like, that's why I asked the question because, right, it's like, I want to see if it absorbed, right? That's why I asked the question. I'm like, there's no bias towards wealth. It doesn't click until it clicks. That's why I do this. Trust me. Like I had to learn at one point too. So that's why I ask all these questions because this is, again, this is not common sense. So a $200 credit card is equal in weight to a 10,000 and you had a question.
I don't know if you're going to cover this, so if you can, I'll wait.
Sure.
But if you have like 3 credit cards, a Visa, 2 American Expresses, and a couple of store cards, does it benefit you to start getting rid of the smaller stuff so that you don't look like you have 7 or 10 credit cards?
Let's talk about it. Let's talk about it. We'll talk about all of it. That's a great question. Okay. So if we do have, and you mean by getting rid of, do you mean close? Okay. We'll definitely go over that. Yeah.
Nordstrom's and
Sure.
TJ Maxx because it was pointless.
Okay. All right. Let's go over it. I like it. Pretty sure every woman in this store is obsessed with TJ Maxx. In this building is obsessed with TJ Maxx. That's hilarious. That's funny. So if you do have 2 credit cards, right, the 10,000 and 200, they're equal in weight. Okay. So I'm gonna focus on this and I'm gonna get to your questions. Okay. So if we have the 10,000 and 200, let's say they're both maxed out. Okay. This kind of goes to your question. If they're both maxed out, which one are you going to pay off first? The 10,000 or the 200? If you have unlimited liquidity. Okay. Perfect. Yeah, absolutely. Pay off. Yeah. So which one would you pay off first? The 10,000 or the 200 if you have limited liquidity, right? To maximize your scores. So if you have 2 credit cards, they're going to be equal, 15% and 15%. So which one would you pay off first? The 200 or the 10,000? Sure. Okay. So and if you have limited liquidity, right, that we would start with the small one first, right? Because it's equal to the large one. Again, very counterintuitive, right? People see these big balances and they're like, oh my gosh, that's a lot. And it is a lot, right? It is. It absolutely is. Like, we don't want to downplay that by any means, but for credit scoring purposes, to maximize your scores, we start with the small ones first. And then when we have liquidity, we move towards the larger balances, because again, they all have the exact same amount of weight. Again, super counterintuitive. Okay. So remember, so if you have 5 credit cards, they're all equal in weight. Okay. So I'm going to kind of jump around a little bit because I do want to answer your question. And what is your name? Louise. Okay. So Louise, I closed out a couple because I haven't used them. Okay. So what generally happens when we close out trade lines? Generally speaking, it's not always a good idea. Sometimes it is, sometimes it helps, but most of the time, the reason we don't want clients to close out trade lines without our blessing is because what happens is whenever you close out, let's say TJ Maxx is open for 15 years, okay? All that payment history that you acquired for 15 years goes away, right? It no longer calculates into the score. So you'll see a pretty hefty drop. That's why it's really important to have credit cards open and keep them open. It's the only type of trade line that you'll never pay off and close, right? A mortgage, the goal is, right, pay it off, it eventually closes. Car loans, you pay it off, you close it. Personal loans, you pay them off, you close it, right? It's the only type of trade line that doesn't get paid off and closed. It stays open indefinitely. So if you're closing it, you do run the risk of dropping the score because you lose all that payment history. And we'll go into length of history shortly, but let's say it was a really old credit card, that length of history is 15% of the score. So a lot of my clients make the mistake of closing out something that's really old, not realizing how much positive it's been doing for the score the entire time. I just saw your reaction. Was it really old? So, well, you closed the card, but you didn't close the account. Oh, darn. Yeah. Yeah, that's a lot.
So I've been in fraud, I've been cleaning it up, it's not my responsibility, but Chase has not been very fair about it.
Yeah.
So I thought I was gonna one up them and close it.
Yeah.
You're losing a good customer. I didn't know that I lost 20 years credit.
Yeah. Yeah. And that's the thing. I mean, people don't know what they don't know, right? And what we don't know can potentially hurt us, right? If we don't understand what we're doing. So that's why it's good to know someone who works in this field, right? So it is what it is. We'll find ways for as well. So it's probably not going to be as bad as you think, but for some people, right, that could be something that makes or break them. And especially since this whole group is mortgage focused, we really want to ensure that people aren't making these mistakes right before going into buying a home, because that's the one big thing I see is people are like so close to buying a home, or they're in that phase, that purchasing phase. All of a sudden they make these mistakes of paying collections or closing out credit cards or opening new credit cards. And so we just want to avoid those common mistakes. So we'll fix it.
I just call them and say, no, once you close.
Once it's closed, it's closed. Yes, it's no longer, unless like by the grace of God, like they allow you to reopen it. But usually I don't ever see them allow you to reopen up an account. So it's okay. It's all right. We'll find other ways to help you recover. So one thing I do want to go over is it's the biggest mistake that I see today. By far, it's by far my biggest complaint with my customers. And if you ever become my customer, and when your clients become my customer and they do this, oh my gosh, it's so frustrating to see, because the damage that it causes is just so tremendous. So the rule is never, ever, 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 ever miss a payment on a credit card. Ever. Okay. So let me show you why. So payment history, 35% of the credit score. Credit cards are 30% of the credit score. Hypothetically speaking, okay, so the principle I'm going to give you, the statistic I'm going to give you, it's meant to knock your socks off, right? It's meant to do this, right? So if you have a perfect credit score, which is a what? What's a perfect credit score? A little higher, 10 points higher, 850, but very close. You can't get higher than an 850. So you can't get higher than an 850, and it's totally unnecessary. Okay. 760, that's all you need. Anything past that is bragging rights, which I get it. People want. Okay. So let's say you have an 850 and you have 1 30-day late on a credit. How many points do you think your score is going to drop? What do you think? 100. Who said 200? 200, 100. I feel like we're like bidding on something. Do I hear 125? 125. What do you think? 50? Just guess. Just guess. Maybe 100? What do you think? What do you think? 50? What do you think, Eva? 200. Really close, guys. It's a 175-point hit. 107 for one late payment. That could be on your store card. That could be on your TJ Maxx card. It could be on your Home Depot card. It could be on your card that you forgot you had an annual fee on, and all of a sudden it hits your account and you forgot to pay it because you don't have it on auto pay, right? I see it every day, literally every day. How long is it going to take you to recover back to your 850? 6 months? How many? 5? 12 months? Okay. What do you think? Couple years? What do you think?
Just a couple of years, but sometimes you can call them.
Mhm.
If you go late, you have a late payment. Negotiate this. This is the first time I was out of country, whatever. They normally sometimes wait and just say, okay, well.
Sometimes, but if we're not so lucky, like 90% of my clients, right? How long do you think it takes? Okay. It's 7 years, guys. It's 7 whole years. It's a 7-year hit. Yeah. It's brutal. So it's the same as, so anything negative stays on your report. What? 10 years. Bankruptcy is 10. Bankruptcy is 10. So it's the same as a collection. Anything negative that hits your credit report is going to stay for 7 years unless a company like mine intervenes. Okay. Every once in a while, you get super lucky. That's usually what I would tell people in my classes. I'm like, listen, go to the bank, call the bank, ask them for forgiveness. But a lot of times we're not getting so lucky anymore. So it usually takes some coaching and a specialist to intervene, because I haven't seen the banks be so nice over the last few years, especially with COVID. It has been a nightmare since COVID. The amount of late payments that have been racking up on people's credit reports. Yes, and yes.
The difference between the due date and 30 days.
Okay, we will go. Okay, so you have your due date, right? And then you're going to have usually like a grace period right after that. Most of the time, I've had accounts where they said, no grace period. You pay on or before, the day after, we will mark you as late to the credit bureaus. So I had 30 days and 30 days alone to pay my bill. But then there's other credit cards, like for instance, like Kohl's, that will give you an entire 60 days to pay your bill. So they give you a 30-day grace period, and then they'll mark you as late. So make sure you understand what your institutional, like what the rules are with inside of your credit card institution, right? Because every credit card company is going to be different. Some might give you 2 weeks outside of, your due date. Some might give you no time whatsoever. So just make sure understand, if you're in that situation, call them immediately and try to rectify the situation.
You had mentioned COVID a minute ago.
Yes.
For the longest time, mortgage banks were saying that pause the mortgage.
Mhm.
But then they didn't always pause it properly.
Right.
They didn't know what they were doing.
Right.
And then they rectified it, and then they would put the 3 months at the end. What does that do to somebody's credit? Because for a time there, window,
Mhm.
they're looking like they're going into foreclosure.
Right. So in those situations, if it was done properly, if they actually deferred the payments and they weren't taking payments, they would just push them back to the end. It preserves the credit. And that was the whole point, was to preserve the credit while also preserving the client's pocketbook, right? While they were not working or whatever was going on, right? So it was to preserve the credit. And if you did it correctly, right, and you called the bank, you got the okay, everything was done in writing, and you readjusted everything on paper, then you were fine. But if you missed the payments thinking it was an automatic thing, like I had a lot of clients that thought it was an automatic thing. Oh, it's COVID, I'm deferred, I don't have to make payments. It wasn't automatic. You had to set up the payments with the companies. Yeah.
And our house went into foreclosure for 1 month.
Okay.
They kept telling us, we just don't have to do this.
Okay.
They were admitting that they didn't know how to do what we had set up.
So that's rectifiable. So that's what I do all day, every day, is I help people recover. So underneath the Fair Credit Reporting Act, Fair Credit Reporting Act, the FCRA, right? The law states that everything on your credit report must be 100% accurate, complete, verifiable, not misleading or obsolete anyway. So when it's a bank's mistake, and if they're refusing to correct it, there's measures and there's ways to make them correct it.
Just go into that, just get it cleaned up with them.
Yeah.
Not wait till the day.
Yeah, we should talk after. For sure. Yes. Yeah. I definitely have a solution for you. For sure.
Like I just did a real bad job.
It doesn't sound like it.
Participants helping us do everything.
all the mistakes, yeah.
Everything that Louise does, don't do that.
Oh my goodness. But it doesn't sound like you did everything wrong because it sounds like you set it up right.
Well, on the regular. Now
Yeah.
I see you, I'm going 200, 300. Yeah, wait, what?
It's brutal. It's brutal. But listen, it's rectifiable.
Better say first. They heard you loud and clear, fixed it. But still, it hit, it went like.
Yeah. Yeah, yeah, yeah.
You get to meet Micah, and if you see her just a minute, she knows what she's doing, and put it in her hand.
Yeah, right.
Yeah.
You're a good hand.
Yeah. We'll take a look at it. But the key thing with credit cards, right? If they don't look at the size of the credit card, Bruce had already given the answer earlier, right? If they're not looking at the size of the credit cards, what are they looking at to give us points out of our credit cards? Payment history, right? That's 35%, so paying on time. But what's the other big part of credit cards? What are they all?
Your spending history,
Okay.
not being late.
Available credit,
Um,
utilization, percentage used. Okay, so percentage used is one of the biggest misunderstandings out there. So from 0 to 100%, let's just say we have one credit card. From 0 to 100%, in order to get the best possible score, what should be reported to the credit bureaus every single month to get the best possible credit score from 0 to 100%? What do you think?
In terms of your usage,
Yes.
I would say less than 30%.
Okay. That's my number one answer. I will tell you guys. 30% is my number one answer. Okay.
9%.
Very good. Very good. So let's talk about 30% utilization, 50% utilization, 100% utilization over the limit. Okay. So when I'm pulling my clients' credit reports and I'm seeing that they're over the limit, it's almost as bad as having a brand new late. You will see your scores drop like you would not believe. Being over the limit is almost as bad as having a brand new late, okay? When lenders look at you and they're trying to assess their risk, right? They're going to be looking at your credit cards and how you utilize them. If you're maxing them out, if you're over the limit, you're considered risky, you get less points out of your credit scores, okay? So if you're, let's say you're at 75% utilization, 75% utilization, you lose 50% of the possible points you could obtain from that one particular card. Let's say you're at 30%. 30% is not bad by any means, but it's not the perfect number. I'm here to help you get to the best number you can possibly get to. The magic number is 10% or less on each credit card. It's not all added together. People open up new credit cards thinking that they're adding to their overall limit. It doesn't work that way. It's broken down per credit card. So the usage should be 10% or less on each credit card. It is mind-blowing to my clients when they pay down their credit cards and their scores go up 100 points. They're like, come on. They're like, what'd you do? I'm like, I didn't do anything. You did it. They're like, no way. I'm telling you, this is where people are like, what's the fastest way to boost my credit score? I'm like, if you have balances on credit cards, that's the fastest way to boost your credit scores. Pay down those credit cards as low as you could possibly get them. So does that mean we can only spend 10% on our credit cards? Is that what that means?
No, we just have to pay the extra.
So this is going to be the big kicker right here, the reporting date versus the due date. Okay, so everybody pays usually, hopefully on time, right, by the due date, but nobody has any clue what the reporting date is. Nobody, and I mean nobody. So when I'm pulling credit reports, I'm looking and I'm like, you're maxed out on everything. Like, what are you talking about? I pay my balances down to 0 every single month. That's at a $0 balance. I've had clients dispute their credit cards because it's reported incorrectly to the bureaus. The problem is they actually just don't understand reporting date. Every credit card reports on a different date, and it's usually like 2 weeks before your due date, okay? So how you find it, so here is an example of how you find it. So this is a statement, right, from a credit card. So essentially, last statement balance as of, and you see a date right here, August 3rd. Right, so you see all this information. This is what you want to look for on your credit card. Last statement balance as of. That's the day that they report to the credit bureaus, right? So if you're going through each of your accounts, you can find this number and you know what day they report to the credit bureaus. Whatever balance you're carrying, let's say you all have this credit card, whatever balance you carry August 3rd, that's what's reported to the credit bureaus. Doesn't report again until September 3rd. Then it's going to report again October 3rd, then November 3rd. It's every 30 days
So
on the
you
same
can have
day.
that, no, August 3rd.
Yep.
But in your mind, think, I have to pay them on the 10th.
Right.
And I'm gonna shoot my check out to them on the, the 7th,
Yes.
or however you get the payment.
Sure.
Yeah. And you're still behind the gun.
Yes, exactly. And that's one of the biggest misconceptions because people have no idea. You could be missing 50, 60, 70, 100 points. How many times do you look at a credit report and you're like, oh, we got to pay on the credit cards? How fast does it take for it to go up? Quick, right? Super quick. Super, super quick. So it's one of the biggest things that people are missing is not understanding reporting date versus due date. Any questions on that? Does that make sense, everybody?
I have a question.
Yes.
Can you credit cards and ask them to change the reporting date?
Can't.
Okay, so that, it is what it is.
It is what it is. Yeah.
You can ask for your payment date to be
Yes.
changed. You can just, that,
Yes.
that's what that was.
That's a really good question. But yes, you can ask them to change your payment date, but reporting date, that's what they have set up internally, right? So the reporting date is the reporting date, okay? That's gonna make all the difference. So if you max out your credit card, you go over the limit, but you pay it down by the reporting date, you're okay. Does that make sense? Okay, so let's go back to my lovely pie chart really quickly, and I just keep going forward and forward and forward. So I wanted to go back to length of history, which is 15%. I'm sorry, 15% of the credit score right here. So 15% of the credit score is going to be derived from length of history. Okay, people have no idea what FICO is looking for. Does anybody here have an idea of what FICO is looking for as far as a number of years? Mike, what do you think? How many years do you think they're looking for to get to a true 850? It's a good guess.
25.
An average of a 25-year length of history to get to a true 850. Okay, so how we maximize this is one of my favorite tricks in the book, tips in the book, however you want to say it, authorized user or piggybacking, however you want to phrase it, okay? So authorized user is one of my favorite tools, but so many people misuse it, and that's the problem. So authorized user, I'll use myself as the example. So my husband was my golden ticket. My husband, don't ask me where this guy came from. This guy has been perfect since like the day he was born. At 18, he opened a credit card. He never missed a payment. His utilization is impeccable. So 2 months into dating, right, he comes into my office and he slaps his credit report down on my desk and he's like, is this good? I'm like, at 840, yeah, it's pretty good. So I'm like looking through this credit report and I'm like, holy mackerel. I'm like, you have a 25-year-old credit card? Like, how is that even possible? And then of course, 18, never missed payment. So I was like, add me to that as an authorized user. He's like, what? He kind of freaked out, right? Because they're 2 months into dating. So I was like, let me explain it. Let me explain how it works. So I was like, you're just going to call the bank. You're going to add me as an authorized user. They're going to send you a credit card with my name on it. You're going to cut it up and throw it away. He's like, okay, now I'm listening. I was like, I don't see it. I don't use it. I don't activate it. I said, but what's going to happen? I said, in about 60 days, everything you've been doing since 18 is now going to be on my credit report. So we're going to compete with each other for scores. And he's like, seriously? He's like, what about like something that you do? He's like, what if like you do something bad? Is that going to impact my score? I'm like, no, nothing of mine is transferable to him. So it's just that one good credit card that he has, it transfers to my credit report. So we both have this phenomenal credit card. And me as the authorized user, I went from 746 to an 825. Insanity. But it was because I got 25 years of perfect payment history, right? I got all of his length of history. I have another credit card, which is I got a brand new type of credit without getting a new credit ding. It impacted almost every single piece of this pie chart here. And all I did was become an authorized user. So the key thing you want to look for is old. Okay, the older, the better. Everybody thinks it's the size of the credit card has nothing to do with the limit whatsoever. It has everything to do with the age. If you have kids, this is how you help your kids. Please do not co-sign for your kid's car thinking that there's nothing that's going to happen to you because I see it every day. Get them an authorized use, get them added as an authorized user, get them phenomenal credit. They'll be walking around with like probably 760 credit scores, and then they can go get the loan in their name and figure out this whole credit thing on their own.
But
right?
you disconnect.
You disconnect. You
Your
never
husband,
give
you
them the
disconnect
card.
from you. and
I've never
that's it.
had it. I've never used it. I've never activated it. I've never even seen the credit card.
You know, I did something similar for my son when he was like, I don't know, when we first started driving for a gas card.
Mm-hmm.
I made him an authorized user.
And then he went to go buy a car when he was about 22. And they said, you know, you're 22 years old, you're still in college, and you have your family's debt,
Mhm.
the mortgage, the credit cards. So thus your credit card stinks. So your credit stinks, even though I did that, because he couldn't show that he could afford to be participant in our debt.
I see.
So I disconnected him, got his own credit card, and in 6 months, he did get fabulous credit score.
Nice.
But did my having him on for a time help him at some point or not?
No, once he's removed for good. So it no longer calculates into the score. Yes,
I have a question.
yes, okay,
Mike just told me an interesting thing.
Okay.
What happens if you get a young guy
yep,
and the parents put him on a credit card that they've had for 25 years?
yes,
But it surpasses when they.
his age.
Okay.
First of all,
Yes.
I'm older than 25.
All right.
Yes.
But my point is that if they take that into account, they go, I think you possibly have had credit, you weren't even born.
99% of the time, they're not even gonna care. It's automatically added
I
and
was just
scores.
telling Eric that
keep it
because of your seminars, I had my father put me on a card that's actually
Older than
11
you?
years older than me. And my score went up like 65 points.
It's insane. It's insane. And until you experience it, and it's until you experience it, you're just like, oh my gosh, I had no idea it could be so powerful. The key thing to make sure is just whoever you piggyback off of, make sure that they pay their bills on time. I can't tell you how many times I remove people from accounts because they're either added to someone who's maxed out over the limit, they're missing payments, and then, right, it's very counterintuitive. You get what they get, right? You take the good with the bad. So just make sure you remember, it's you get the whole thing of that person. So whoever they are, right, you get all of their spending habits included. So hopefully they're good. So piggyback off of
So
them.
then before you would make that determination, you would go to FICO.com that you just mentioned earlier and look at it. They would do that, right?
Absolutely, yeah. And most people with good credit, they know. You know what I mean? And most people with bad credit, they kind of know.
They
You know
also
what I
have
mean?
to check the payment date versus the due date, because I know somebody that did that, but the person always had great credit, but they didn't make that payment, prior to when it was being reported.
Mhm.
So they're thinking that they're paying their bills every month. They added this particular person, and when they ran the credit report then, it showed a large balance.
Yeah.
And it showed a large balance, and that hurt the credit
Yes.
as opposed to helping it.
Yeah.
So.
So all those little things, they're all factored in. So just make sure, be cognizant, whoever you piggyback off of, just make sure it's someone who's pretty fiscally responsible, right?
But to your point, right, if I pull somebody's credit and they have 3 accounts that are their authorized users on,
Say that again,
if I pull somebody's credit
yes.
and they have 3 accounts where they're the authorized user, and let's say those got balances on them.
Yeah.
If I'm doing a mortgage for them, I don't have to use those balances or payments against that person because they're authorized users. They're not responsible for the payment. So in the
Okay.
mortgage, so when you talk about a card thing,
Yes, that was a little
that's
different.
different.
Yeah.
In the mortgage world, if you're an authorized user, we discount that payment associated
Oh,
excluded.
okay. You would think, okay, you would think the car people would be more.
Well, a car's easier to repossess.
Because you said earlier, it started in the beginning, that everybody pulls credit a little differently.
Yes.
There's a perfect example.
Yeah.
Because
Yeah, all different guidelines. Everybody has different guidelines of how they're going to look at you as a whole. Absolutely. Yeah, that was really good. Thank you. I didn't know that. So let's talk about new credit really quickly. So new credit is anytime, obviously, you get new credit. What happens to your scores? This just happened to my client the other day. He called me panicked. Okay, he just closed on his home. He panicked though because something happened to his credit. So did it go up, down, or did it stay the same? Like what happens
It
when you
went
get a
down.
new? Why?
because he now has like a $300,000 debt or a $500,000 debt.
How long does it go down for? Pretty close, yeah. So it's 4 months, right? It's just 4 months. All they want to do, so you get a temporary hit when you close on, let's say, a mortgage, a car loan, something to that effect, right? Because they want to see how you do with what you've been given. Could you imagine if your score went up, if after you got a mortgage and you're like, sweet, I'm going to go buy some jet skis. And then it went up again and you're like, all right, I'm going to go buy myself another car. Could you imagine? It would be absolute pandemonium, right? So we want to make sure we understand when something new hits our credit, our scores generally take a pretty decent dip. So based on the national average, it's about 5% of whatever our score is. So on the national average, it's 41 points for 4 months. So every month that you make a payment on time, you're gonna get those points back, okay? So just make sure, we don't tell clients not to get something new because we just don't want them to get something new. It's for a good reason, right? We don't want to screw up their DTI, which is their debt to income ratio with the mortgage company, and with the credit, right? That could be something where it takes them from one tier to the next, right? We don't want that. So let's talk about next what happens also with new credits. I want to talk about the inquiries, because inquiries is one of the biggest questions that people have, is what happens to my credit when somebody runs it, right? So does everybody know what a soft pull is? Does a soft pull impact your score? Does anybody know? Does it show up anywhere?
People always, when we say it's only a soft blow, they say that that's still it's a small hit. That's
Okay.
what people respond back, and I don't have an answer to that small hit, is it?
Okay, very good. Anybody have any thoughts around soft pulls? Anybody else?
No.
Okay, yeah, no impact. Soft pull never impacts your score. That's the good news. The soft pull never impacts your score. Can it show up on a credit report? Yes, it can, but it has zero impact. A lot of mortgage companies now are doing soft pulls, and it will show up on the report, but it will not impact the score at all. You can literally do 1,000 soft pulls a day and it never impacts your score. So anytime you just want to see where you're at, you're not applying for the debt, you're not applying for a loan, you're not applying for the credit card, it's not going to impact your score. So a soft pull, again, you can do it 1,000 times a day. So that's why I like the Credit Karmas, even though it's not the correct mortgage score or credit score for a car or a credit card, right? At least it's showing you what's going on for like the last 2 years. At least you kind of have an idea what's going on, right? So we want to make sure, right? I just lost my train of thought. Literally just lost my train of thought. Oh my gosh, what was I talking about? I like literally started like thinking about so many other things about that I wanted to talk to you about.
Inquiries.
Thank you. Thank you. Yes. So a soft pull, so you can check your credit 1,000 times, a soft pull, Credit Karma, My Score IQ. There's so many places to check it and it's never going to impact you versus a hard pull, right? A hard pull is how many points? That's it. It's 2 to 5.
5 points, that's it.
2 to 5. That's it. It's
And
so
this is why,
minimal.
yeah.
And meanwhile, buyers are so afraid.
Everybody thinks it's like 40, 50. I get 40, 50, 60. I've had people guess 100.
Hey,
my
Mike, do
classes.
you have something that we could give to our agents that is like a cheat sheet? A flyer, I mean, we could make one for you guys.
You should.
But I would like it with your information on it. We
Yeah.
would pass it to everybody.
I have like a little flyer, but it doesn't have everything that I talk
Not
about.
everything,
So-
but that's a big one. For
Yeah.
agents, one of their big objections.
Yeah, I'll put them
Hey, I already
together.
had my credit run. I know you want me to use your guy.
Yeah,
I'm not to get my credit running.
yeah.
But first thing you should know is we do soft pulls at cross country, number one, and a hard pull is 2 to 5 points. So you never.
I've been on both sides of something that would help, and I'll tell you, I had a seller who was selling his house and then the guy didn't get the mortgage. Now the seller becomes crazy. So at the time, we were with Contour and I said to the new buyer, I said, well, it didn't work out. I said to the new buyer, I'm sorry.
That's the reason.
No, that had nothing to do with the
No,
first
it's-
problem. What I'm trying to say is, now we have a new buyer along and I've got a third seller. So I said to this new buyer, nothing against who you're using, but my seller will choose you if they know you're in the hands of somebody that'll get them a mortgage. Because the last person didn't get a mortgage. So the seller was hesitant because of the pulling, but eventually went and got the mortgage. So, but that was a hard conversation because now I'm forcing somebody, I'm saying you can only be our seller if. And then I had the same situation this year where I had the buyer and the agent did that to me. You can only be our buyer agent and buyer if you use my person. And it was the same soft pull, hard pull story. So if you have something that we can put, that's not coming out of our list,
Of course.
that would be the best
Yeah.
way to alleviate that situation. Because
Yeah.
there's a lot of people that are back on the market
Sure.
because people didn't get mortgages.
Yeah, we'll come up with something that we want
We can do it. Did you
Co-brand.
know?
Sure.
Yeah.
Did you know?
to, yeah, we should do something like a co-brand thing where we put
Yeah.
something out for them. 100%. I think it's a great idea.
Yeah.
So the other thing that I want to go over as well is the shopping window. Okay, the mortgage industry is the only industry that has a shopping window. Does anybody know what a shopping window is and what it means?
Wait, hold on. I bet Mike does.
I
Mike, you know?
I do know. I don't know if you want to.
It's up to Michael. If he wants to answer, he can
You're
answer.
gonna run out of cold stove. I can tell you that.
I'm already out. Yes, go ahead.
Oh.
It's a shopping window, it's in 1 month, you can shop around as long as you can, and it won't affect your credit score, is that right?
Yeah, exactly. Yeah.
Now I know
So
you-
you have a window, right? So you can, so the mortgage industry allows you to shop, right? It allows you, because different banks have different products, not one size fits all. It doesn't work like that. You should absolutely see who is the best fit. So at the end of the day, they give you the ability, right, to go and shop lenders. So in the mortgage industry, you have a 14-day shopping window. So let's say you go to Contour first, and you're like, no, that's not really my jam. Then you want to go to
That
Cross.
typically happens too, by the way.
With and let's say you go to cross country next. You're only going to see one impact, one ding to your score within that 14-day window. So you can have multiple pulls within that 14-day window. It only impacts you one time. So don't be afraid to go to somebody else. So if he's the second guy, that's okay. It's not going to impact you. And like he said, he does a soft pull, so it's not going to hurt you anyway.
Is there a limit to that, Mike? Like, is there a limit? Like, if you say that, someone goes, hey, look, I'm gonna go to 15 lenders.
Not that I'm aware of. As to my understanding, the mortgage industry, so FICO will actually recognize the mortgage industry algorithms. It'll recognize.
Start at their bank.
What's that?
A lot of buyers, I think, do
Sure.
start at their bank.
Yeah,
So
yeah,
the
yeah.
bank does a hold, and now they're calling us to help them.
Right.
So we would be saying to them, did they just do it? Because
Yeah.
they just did it, do this now.
And that's
Yeah.
right, and that's,
Yes.
that's really a good point, right?
Yes.
Right, as agents, you should be in the know about that.
Yeah.
Right, that would be the first question you'd ask.
Yeah.
Exactly right.
Yeah, no, that's really good. And yes, to your point, not that I'm aware of. I've never seen there be an issue with how many people, but that's really aggressive. If you're going to like 30 banks in 14 days, like that's a lot.
Some people don't know. and,
Sure.
You know, everybody tells them what to do, and they go to 7 different places.
Yeah.
In 2 minutes, they shot down no longer.
Yeah.
You know, everybody's very aggressive now
Yeah.
because of the economy.
Oh, sure. Yeah. Versus the car industry. You go get a car, the rules don't apply. If you go get a car, let's say you have less than amazing credit, they're going to shop you out to every bank that they know. So you're going to get like 25, 30 different hits all at once. I've seen it. I've seen 150-point drops after somebody with not great credit can't get financed in-house, right? They just want to close the deal. So they will shop you out, and it's pull after pull after pull after pull after pull. So if you are going to buy a car, say, I want one pull and one pull only. If I can't get approved in-house, right, then I don't want you shopping, or I don't want you shopping my rates elsewhere. Okay. So any more good
car
questions?
dealerships?
What's that?
Is that what they do? at car
Oh
dealerships?
my gosh, yes.
They
It's
shot
one of
them-
the
they
biggest
send them out
issues we
sometimes
see.
10, 15 lenders.
It's horrible. It's horrible. I'll see a 30, 40,
So
50,
that's
60.
generally when their client is a weak client.
They give you
Yes.
subprime.
Yes. And that's the thing is people who are struggling, they're struggling even more.
Yes.
And a lot of these people are overfocused.
All right, let's talk about the fun stuff, the negative stuff. All right, so what can be removed from a credit report? I think when I talk about the negative stuff, it's all, I could probably come back here 10 times and you would learn something new every single time. It probably took me a full 2 years to really grasp even what credit repair was capable of. I really didn't understand. I would literally go back to my trainings, like literally once a month, and I'm like, I just don't understand. I'm like, how are we removing things that somebody did? I just don't get it. It never made sense to me. And after a couple of years, I really absorbed what it is. It's very similar to the court of law. It is very, very similar. Well, it's truly innocent until proven guilty. So it's my job to essentially build a case for a client to force the bureaus and the creditors, right, to verify it's 100% accurate, it's complete, it can't be obsolete, it can't be misleading. So you might see something on a credit report and you're like, oh, that hurts, it's not coming off for 7 years. I see it and I'm like, gimme, because it's not reported accurately. It's not about did you do it, it's can they prove it, and is it reported accurately, right? So everything negative at the end of the day has potential to be removed. Doesn't matter if it's a late payment, a collection, a foreclosure, right? Tax liens, medical collections, bankruptcies, charge-offs, judgments. There's more than that. There's a lot more than that. But everything negative has the potential to be removed. So don't think someone's so far gone like this isn't fixable. That's not the case, right? Everything negative has potential to be removed. It's just a matter of how long, right? That's the key, is how long. So some cases take a lot longer than others, depending on what type of negative item it is. The key thing is I want everyone to have a second chance. I don't think it's right that people get punished for 7 years plus for one mishap that may or may not have been their fault, right? So how it happens, so you've heard me talk about the FCRA a few times now, the Fair Credit Reporting Act. There's a lot more laws than just that. And I'm going to talk about one big rule change for New York as well. But the FCRA states exactly what I just said, is that everything on the credit report must be 100% accurate, complete, verifiable, not misleading or obsolete in any way. So let's pretend you have a medical collection, okay? So medical, right, it used to be the biggest and it still is pretty large as far as like the types of things that I go after. So what I do is I go to the bureaus and I'm like, all right, give me the name of the doctor, the anesthesiologist, what time did the patient enter the hospital, what time did they leave, what did insurance cover, what do they not cover, why? The bureaus don't have to have that information, but guess who does? The collection agency, right? So when I send that off to the bureaus send it off to the collection agency. They have 30 days to respond with all of that information. Well, here's the funny thing about medical. You ever heard of that little law called HIPAA? They can't release the name of your doctor or your anesthesiologist or what time you got to the hospital. And if they do, they're now in violation of your rights, which means they have potential liability for a lawsuit. So this is how we win our little cases, right? Because now it can't be verified because the information that we're requesting, if they submit it and they provide it, that could potentially really get them in a lot of trouble, right? So it's a very fascinating industry when you know the ins and outs of how the industry actually works. But if it can't be verified, right, it cannot stay on the credit report by law. That's how it works, right? So they have essentially, there's a 30-day window, right? So legislation changed a little bit during COVID. It did get a little bit longer because the bureaus were so severely understaffed, right? So legislation, so 60 days usually was how long it would take for one round of investigations to complete. So in one round, as you and I have seen with a lot of your clients, like one round can change someone's life like this in a positive way. So let's go into my next slide. It throws me off having a slide. Normally I just talk. So what is the cost of having an inferior credit score? So I actually just did a video on this yesterday. This is probably one of the biggest reasons I got into this business, is understanding the cost of things. If you have a breakdown sitting in front of you and you still decide to go ahead with whatever it is you're trying to buy, fine. It's my job to educate. What you do with it, that's up to you. Right, but let's just pretend. So interest rates as of 8.5, and again, these are general numbers. Okay, these are averages. So 30-year fixed loan. I just chose national, right? I didn't choose New York. Let's pretend your client is getting a $450,000 loan. Okay, so this is a really cool. So this is called the loan savings calculator, and you can find this at MyFICO as well. MyFICO has a loan savings calculator, so you can play with this. You can see this. You can send it to your clients. It's awesome. It's free. But essentially, you plug in a credit score, right? And based off of the average rates going on at the time, it's going to populate the rate, and it's going to populate the entire amount of interest paid on a 30-year time period. When I see these numbers, when I first saw them many, many years ago, I about died. I was like, oh my gosh. I'm like, I was like, no wonder the big banks are so wealthy. So if you have a 620 to a 639 credit score, right? This was 8.5. The APR was 6.3888%. Your monthly payment would be $2,811. Over 30 years, you would pay $562,047 in interest. $562,000. If you change your credit score into premium tiers, let's say you go to 760 to 850, your monthly payment drops to roughly about $500. You're now down to $2,361, and you're probably not paying mortgage insurance, right? So now, total interest paid, right? $399,860. That's $162,000 in savings. Now, that's why I teach credit, and that's why I'm so passionate about credit scores. We're not even talking car loans. We're not talking how much you're overpaying for your insurance. You're not talking credit card interest rates. What people don't know is that credit card interest rates this year, 4 times, they have raised short-term interest rates to try to offset inflation. I'm watching people's credit card balances literally go up as they're paying the minimum payments every single month, because to offset inflation, they've raised short-term interest rates on people to stop them from spending. This is what's happening in our economy right under our very noses. We are simply paying the big banks ridiculous, astronomical amounts of money because we haven't been taught this stuff. And this is why it's so important to understand the principles, because $150,000, I don't know about you, but I could do a lot with $150,000, right? So that's like your kid's education, right? That's like savings, like decent savings. So to restore and repair the credit, so the way that we work is this. So normally, so a client comes to us, we always give a free consultation. Anyone that comes to me, I'm going to look at their credit report first, right? So myself and my team, we're going to take a look at the credit report. We do a full in-depth analysis consultation. I want to see what you're doing right, what you're doing wrong. I'm going to talk to you about essentially how much you should be spending. I'm going to give you all your reporting dates, right? You're going to see all of your reporting dates because my credit reports pull those, which is pretty cool. And it's a soft pull, doesn't hurt your scores. So the consultation doesn't cost you a dime. Right, so once they decide to enroll to get the errors corrected, I call them errors, right? So anything negative has potential to be removed. So error correction is what we call it. So normally it's $199 to start. All of your clients get a $100 discount. It's just $99 to start. That's it. That's all it costs. And then the monthly fee is $129 a month, and there is no contract to remove the negative items from the credit report. That is nothing compared to the savings that you're going to see that are going to last you a lifetime. It's the only type of investment of its kind where it'll pay you dividends over your lifetime. Right?
Typically, you're going to be able to help somebody at what period of time?
Good question. So I think it was on one of these slides. So generally speaking, most of my clients usually spend about 4 to 7 months with me. Sometimes you see freak clients. I have some clients 200 points in 60 days. I have freak situations. Most of my clients, though, are going to spend about 4 to 7 months with me. But again, that's the importance of having the consultation is when we look at the report, I'm going to be like, okay, listen, so you're at a 400 now, we're trying to get you to a 700, you have 75 negative items, probably going to be together closer to a year, right? So depending on the goals, depending on the situation, depending on what's going on, obviously is going to determine, you know, the average for that individual. So, but generally speaking, 4 to 7 months, okay? Does anybody have questions about that time frame as far as like how that works? Okay. So if you have clients to send over, so every single one of you is going to be built your own individual portal. So I'm going to make sure to collect every card from all of you, and I'll give you mine as well. So I'm going to make sure to build your portal for you so you'll get your own personal portal. So if you want to send a client over, you can send them over through your portal, right? It goes straight to our team. We call the client. We obviously say, hey, because you came through so-and-so, right? You're getting the discount. We go through our whole spiel. So you can do it that way. You can make an email introduction. You can do a text message introduction, or if you just want to send the information via email, that's fine. However you want to send the client. One thing I do ask of you is this, and this has been a big ask for a long time, is please don't give the clients my information. Why in the world would I say that? Is it because I don't want them to call me? No, it's because they don't call. Most clients don't call. That's one of the biggest things that I've seen. Either they're scared, they really don't know much about credit repair, and it's also that it's just one more thing for them to do, right? So they're like, oh, this long list of things that they already have on their plate. I'm like, so just put it in our hands, and at least the professional, because we're the professional, we will call. So at least they know, listen, this is what we do. We're here to help. And if they decide not to return the call, that's one thing. But most of the time, I'm telling you, they don't call. Or if they do, I'll say, who referred you? It's like, oh, she's so nice. Where's her card? Where's her card? And they have no idea who referred her or him, right? So I don't know who to send them back to. So that's the other problem. So I want to make sure anybody you send over, the whole goal is to get them back to you as a closable client. So if I don't know who sent them, I don't know who to send them back to. So that's why I say, try to send me their information so I can make sure to send them back to you. Yes, Eric.
So the beauty of what Micah does, and this is how we use it, and this is what I would suggest a lot of you do, we get clients that are in here, we just cannot get them a mortgage. So we send them over to Micah, and then we continue on our way. And long and short, sometimes 2 months, sometimes 3 months. But in 4 months, we get a call from Micah's office, and they say, this client is now ready to buy a house. And I find those are the most gracious people because we sent them over to Micah, she fixed them all up, and they're ready to buy a house. And a couple of months go really, really quickly. And I think some of those borrowers are the best referral sources that we have.
Absolutely.
So it works out really well, and you know, out of sight, out of mind. Sometimes 2, 3 months when she calls, she forget about the borrower, and they're ready to go.
Yeah, absolutely. And I will tell you, people who have been given the opportunity to rectify a situation, I tell you they're so grateful, and they usually have like 5 other referrals because there's probably like 3 other people that just turned them away. They said, come back when you fix your credit, but they didn't give me any solutions. There was no solution. So if you're turning somebody away, like offering a solution is always, you know, like you said, big banks.
No, I just say they run in packs.
Oh, they run in packs. I thought you said like big banks.
Like I'll be in a coffee, you know.
Yeah.
Having coffee. Oh, me too. Oh,
Yeah.
I use Micah Curtis.
Oh, yeah. I know it's hard to get used to, right? I know, I've been around a long time. Yeah, so it's one of those things. It's just the key thing is right? We care about people. People don't care how much you know until you know how much you care. That's just a fact, right? So helping people get past this hurdle in their life is freaking awesome. It's a really cool feeling, and it's a really awesome thing to watch somebody, because most people who have bad credit have been struggling with it, and they're embarrassed and they're frustrated and they don't know how to overcome it. And so having somebody and watching them go through that stage and watch them go through that victory, it's a pretty gratifying process. So I did put up here what, so if you Google my company, Micah Abigail, that is the name of my firm. We've done okay for ourselves. So we have quite a few 5-star reviews, which is great. We've helped quite a few people in a very short amount of time close their loans. So again, we get some miracle cases, and then we get some ones that sit with me for a little while, but we get them to where they need to be, you know, as long as they follow the instruction and they don't keep incurring new late. Any other questions? You guys have been really gracious today. Thank you for letting me talk and talk and talk. I can talk a lot more if you want. I got more.